In this video, I'm going to be showing you the growth stock that I'm going to be buying in June 2020 in my dividend growth portfolio. Disclaimer, I'm not a financial advisor. If you seek financial advice, please see a licensed professional. Typically on this channel, I look for dividend growth stocks. And whilst this next stock I'm going to pick does have a dividend, it is mainly known for its capital appreciation. But I do think that this capital appreciation of the stock has a lot more potential than that of the dividend yield. And in fact, today I'm going to be looking at a stock in a sector that I typically very much neglect. And that's because I believe that the industrial stocks are in a bit of a recession at the moment. I know the UK can be in the deepest recession we've seen yet, but I do believe this to be quite a sector that you might not get too much gains on, very similar to energy lately. However, this stock I think is quite well managed, and I do believe that it has the ability to outperform others in its industry, and that's because it rents construction equipment and industrial equipment for non-residential construction sites, which means that they are renting to other construction companies to build commercial property, which means they don't actually have to do so much. In fact, they've just got to manage their assets and leverage debt effectively. And this company owns about 773 stores in the US, a certain amount in Canada, which I can't remember, and about 196 stores in the UK. So they are quite diverse and they are exposed to the American market. But personally, I haven't heard much about this stock. And it intrigues me because it's got an impressive market cap. But currently this stock is trading near its all-time highs in February, and that's because lately we have seen a significant rally in the market. However, by the time you watch this video, we might experience a June crash, and in which case this might be a great value opportunity, but at the moment it isn't. You'd buy this for its potential growth in the future, and it is great to jump into due to its high volatility. Since it's got high volatility, it's going to fall further than the market and grow further than the market, giving you ample opportunities to average in at a lower cost basis and therefore make more capital appreciation in the long run. And if you're interested in monthly stock picks for the Ftse 100 and the Ftse 250 and weekly portfolio updates, please consider subscribing. Thank you. They are currently trading with a price to earnings ratio of around 14.8 times, which is actually higher than that of its industry at 13.5 times. It is slightly less than the market, but it does mean you are trading a bit of a premium for this company, its industry. And in fact, I think it actually deserves more of a premium than it currently has. This company is so well managed, they have great debt asset management, meaning they can leverage their debt effectively, and so such a high debt to equity ratio, even though they've reduced it over the last 5 years, does not concern me that much. And currently I believe they have about 154% debt to equity ratio, which is high. You might deem as risky, but as a growth opportunity, you want to see them do that. You want to see them leverage it. You want to see them have a high potential return on capital employed. And speaking of that, it generates a return of equity of 28.2% per year, which is incredible growth. And in fact, if that keeps increasing, then surely the stock price is going to increase at some percentage of that as well. And yes, it would be slightly skewed by the high amount of debt, but it still is an impressive figure to have. Ashtead Group, AHT, has seen their earnings grow significantly over the last 5 years. I believe that it has grown by an average compounded rate of 23% per year over the last 5 years, which again is incredible earnings growth. And currently that price to earnings ratio is constantly going to be battling it. So I do think that this should be trading at a much higher premium than it is already. And their financial position is actually quite strong. Yes, they don't have too much short-term assets, but they don't have too much short-term liabilities either. They don't need too much to stay afloat, as it's mainly just renting it to other companies. And these sort of rental ideas aren't necessarily shut down too much during a lockdown, as I do believe that there are some construction sites that they're still working. And in fact, these lease contracts might have been done in advance, and therefore they might still be getting paid income because a company has decided to rent a certain product for a year period, for example. But they do have less short-term assets than long-term liabilities. But as I said, I do believe they leverage their debt effectively, and this should not be an issue for a company like Ashtead. While I mentioned earlier it is mainly known for its capital growth and great shareholders' returns, we shouldn't ignore the dividend. And yes, the dividend yield is quite low at the moment at 1.56%. You may just dismiss it, but their dividend growth is nothing short of excellent. Currently, the dividend yield has been increasing at a greater rate than the stock price, which means they've grown their dividend more than they've appreciated in capital price, which is quite incredible considering the shareholders' return over the last 5 years with dividends reinvested is 150.8%, meaning that they've grown their dividend by more than that in the last 5 years. And in fact, over the last 10 years, they've averaged a year-on-year annual compounded growth rate of 31.77% each year in dividend growth, which is truly incredible. And whilst this may not be sustainable, they do currently have a low payout ratio of around 25%. And so in the future, they could look to ramp up their dividend, and they've still got so much cash flow that it doesn't matter. Ideally, however, I would like it to be lower, their payout ratio, because I think they can reinvest that profits into their company and continue to grow further in capital price. But at the current rate they're doing it at, it's a good balance and they're doing very well for it. Whilst yes, in the last 20 years they have suspended their dividend, which was the period of 2003 to 2005, in which there was no dividend income. However, every year since, which has been 14 years, they have consistently paid and grown their dividend. And the shareholders' returns of 150.8% has tripled that of its industry, which only had a measly 50% return with dividends reinvested. And this is all whilst thinking this is a UK listed stock in the Ftse 100 that would have been priced in for Brexit, now hit by the pandemic crisis, and it's nearly trading at all-time highs. You can see why investor sentiment is so large for this stock. Click the card at the top right of the video to see which Ftse 100 dividend stock I'm buying in 2020. Thank you for watching. I'm Osborne Foreman. Have a great day.